Index fund mutual funds are two types of investment vehicles, but they have some key differences. Management style. Index funds, these are passively managed and aim to replicate the performance and a specific benchmark index such as S&P 500. They automatically track the index, so there is no need for active decision making regarding buy and selling securities. Actively managed mutual funds have a team of managers who make decisions on buying and selling securities with the goal of outperforming the market. Passively managed mutual funds. Index fund. The objective is to match the returns of a benchmark index. Mutual funds. The objective can vary. Some aim to beat the returns of a benchmark index, while others may have different goals such as index funds generally have lower fees because they are passively managed and do not require active decision making. Mutual funds can have higher fees, especially if they are actively managed, due to the costs associated with the research and active trading. Portfolio composition. Index funds investment in all or a representative sample of the securities in the benchmark index. Mutual funds, the portfolio composition can vary widely depending on the fund's strategy and objective. They may invest in stocks, bonds, or other securities. In summary, the index funds are typically more cost effective and have a more predictable performance compared to actively managed mutual funds. However, actively managed mutual funds may offer the potential for higher returns if the fund managers